Hello friends, we are going to have the revision of input tax credit and sorry I could not upload the explanation video on the revision so immediately because I was not feeling well and just now I am recovering, so due to that reason, so as soon as possible I wanted to do that, so I am doing this input tax credit ka revision. So let's this week revision and things will do. Explanation video definitely I will upload. So first we'll start with this ITC. So these are the various topics that we are going to cover in this. So that is availment of ITC in GSTR 3B, section 41, then section 49, subsection 5, manner of utilization of ITC, then section 16, condition for availment of ITCs, then apportionment of ITCs and blocked credit, section 17, then availment on reversal of ITC in special cases, that is section 18, job work provisions is section 19, then we have input service distributor concept, section 20 and 21. Okay, these are the areas. So first we will see about availment of ITC in GSTR 3B, section 41, read with rule 36 sub rule 4. So we have certain returns. GSTR 1 is a return that will be filed by every registered person containing the details of outward supplies, and GSTR 2A based on the GSTR 1 of the supplier. So to the recipient the inward supply details are made available an auto populated statement, that is GSTR 2A, and GSTR 2B is also an auto populated statement, but the difference between GSTR 2A and 2B is that GSTR 2A is a dynamic document, so it will get updated very frequently, but 2B is like a static document, so it will be generated on one particular date, and that is the ITC. So it is based on the cutoff dates, the ITC will be available. Like for example, GSTR 1 is filed by the supplier by the due date, up to the date whatever or the GSTR 1's filed, that data will be reflected into the 2B of the recipient. 3B is a return which will be filed by every registered person that contains the details, consolidated details of liability, input tax credit, interest, late fee, etc. And 2A, 2B you can see type, 2A is dynamic and 2B is static. TDS, TCS details will not be there in 2B, but it will be there in 2A. And details of invoices if GSTR 1 filed after due date. Suppose if the GSTR 1 due date is 11th and if it is filed after due date also in 2A, it will be reflected of that month. But in 2B of that month it will not be reflected, however it is reflected in the 2B of the subsequent month, and the purpose is just for reference purpose 2A, but 2B is for availment of ITC. So rule 36 sub rule 4 says that only the matched ITC can be availed. That matched ITC is that ITC which is reflected in GSTR 2B of a registered person. And what we will do is that first we will see the GSTR 2B. So supplier has furnished his outward supply details in GSTR 1 or invoice furnishing facility, and that is filed by the due date. So based on that it will be reflected in GSTR 2B of the recipient, and this is called as the matched ITC. So very importantly, that outward supplies should be filed in GSTR 1, it should be filed by the due date, then it will be coming in 2B. This is called as matched ITC. To this matched ITC we will be doing some adjustments to know the self assessed ITC. So what are those adjustments? First we will take ITC as per GSTR 2B. After taking ITC as per GSTR 2B, that is the starting point, we need to add three things. So even though it is not reflected in 2B, but still we can take. So reflected in GSTR 2B or not reflected in GSTR 2B. So it is not reflected in GSTR 2B. It is not reflected in GSTR 2B, but still eligible. Still we can take. What is that? So GST paid under RCM and reavailment of ITC reversed earlier, and ITC not availed in earlier period but reflected in 2B of the period. So these three cases, even though it is not coming in GSTR 2B, but still we can take ITC with respect to that. GST paid under RCM, reavailment of ITC reversed earlier, ITC pertaining to not availed during the earlier tax periods but reflected in 2B of that particular period. Then next three cases we need to reduce, that is reflected in 2B but ineligible. So we need to reduce. What is that? Blocked ITC. So blocked ITC, so ineligible, like we have. Then inward supply used for non-business purpose, inward supply used for exempted, even though it is coming in 2B, but you should not be taking this. Next we have reversal of ITC if supplier not filed GSTR 3B. Suppose if supplier has not filed GSTR 3B for a particular period, then in that case, so we need to reverse the ITC. But how that works, that is given in section 41, read with rule 37A. So see this, supplier first reports the GSTR 1 and file it by the due date, then it will be reflected in 2B of the recipient, auto populated. As and when it is reflected in 2B of the recipient can avail the ITC in GSTR 3B, that is self assessed ITC. Now the supplier is not filing GSTR 3B by September 30th of the next financial year, then the recipient should reverse the ITC by 30th November of the next financial year. Suppose if the recipient has not reversed the ITC by 30th November of next financial year, then the interest needs to be paid. Okay. If not reversed by 30th November of next financial year, interest at the rate of 18% shall be payable from the date of utilization till the actual date of reversal or payment. Okay. Then here you can see, suppose at a later point of time, if supplier files GSTR 3B after September 30th, then can the recipient enjoy the ITC? Yes, he can. That is, whatever ITC reversed can be re-availed without any time limit. ITC reversed earlier can be re-availed without any time limit. So can we avoid the interest? Yes. To avoid the interest, we need to reverse the ITC by 30th November of the succeeding financial year. Otherwise, only interest will be payable, that too from the date of utilization. What if the ITC is not at all utilized? Then we don't have to pay interest, and we need to know when it is utilized, the balance in ITC falls below, whatever balance in ITC falls below the availed ITC. To that extent, the availed ITC has been utilized. Okay. Then next we have manner of utilization of credit. Manner of utilization of credit is given in section 49 subsection 5 of CGST Act. So principle number 1, there is no restriction with respect to IGST. So this is the principles that we need to learn with respect to IGST. There is no restriction with respect to IGST. What does it mean? IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. Then number 2, between the other 3, CGST, SGST and UTGST, respective credit should be utilized for payment of respective liability, and cross utilization is not possible. That is the first principle, and this is given in 49 subsection 5. Second principle, the priority. So when I have IGST credit, first I need to use it for payment of IGST liability. Thereafter, between CGST, SGST, UTGST, in any manner, any proportion, that is given in Rule 88A. That Rule 88A says you can utilize the IGST credit first for IGST, thereafter CGST, SGST, UTGST in any manner, any proportion. Then what about the CGST credit, SGST credit and UTGST credit? First for payment of its liability and then for IGST payable. Then third principle. So before utilizing CGST and SGST credit, the credit of IGST should be completely exhausted. So first IGST we need to spend, then only we need to use CGST, SGST. Then principle number 4. When I have IGST liability and all the credits, first I need to anyhow adjust IGST credit, thereafter CGST credit, and thereafter SGST or UTGST credit. So when we use IGST credit for payment of IGST liability and then for CGST, SGST in any proportion, so multiple answers are possible. So therefore, what you need to do is that depends upon the CGST, SGST liability you apportion. So see the ratio, in that ratio you apportion. And can the GST compensations be taken as credit? Yes, GST compensations can be taken as credit, but that should be utilized only for payment of GST compensations, which means that if you have GST compensations in the outward liability, then only you take credit, otherwise don't take the credit. Then condition for availment of ITC is given in section 16. So which says, point number 1, only a registered person can avail ITC, unregistered person cannot avail ITC. Number 2, the inward supply should be used or intended to be used in the course or furtherance of business. Number 3, recipient should be in possession of the tax paid document. The person who wanted to avail ITC should be in possession of tax paid document. What is a tax paid document? Tax invoice, debit note, ISD invoice, bill of entry. These are the tax paid documents, and the tax invoice can be given by supplier to recipient, or the tax invoice can be given by recipient to supplier. Then point number 4, recipient should have actually received the goods or services. Recipient should have actually received the goods or services. Then means, for example, if invoice is January month but the goods and services are received in February month, ITC can be availed only in February month. And supplier should furnish the details of invoice in GSTR1. So because only when it is coming in 2B we can take ITC, that's why that condition. Then supplier should have paid the tax, but here he should have paid the tax by September 30th of the succeeding financial year. Means you need to file the GSTR 3B by September 30th of the next financial year. That is given in Rule 37A. So therefore it is not a condition that at the time when we avail ITC he should have paid. So but he should pay it by September 30th of next financial year, otherwise we need to reverse the ITC, that is the meaning. Then recipient should have actually filed the returns, that is GSTR 3B, and GST paid on inward supply which is reflected in 2B should not be restricted in 2B. In 2B there is ITC available, ITC not available, and ITC reversal. So whenever supplier not filed GSTR 3B by September 30th of the next financial year, this will be coming under our ITC reversed. So we have 3 columns in GSTR 2B, ITC available, ITC not available, ITC reversal. So if the supplier is not at all filing GSTR 3B by September 30th, then after September 30th to us in our 2B ITC reversal will come, so that we need to reverse. ITC not available because of section 38. So as per section 38, supplier has not at all, he is a newly registered person. All these are defaults on the part of the supplier. So supplier is a newly registered person, or supplier not filed GSTR 3B, or supplier has availed the ITC in GSTR 3B more than 2B, or supplier liability in GSTR 1 is greater than liability in 3B, or supplier default in payment of tax and the default continues and the notices have been given, or the supplier failed to pay 1% of the liability through electronic cash ledger, like that. There are some situations given in section 38. So you can see in this book itself, section 38. So in those situations, what will happen? The ITC will not be coming in GSTR 2B under ITC available. It will come. Even though supplier filed GSTR 1, it will come, but it will come under ITC not available, which means we cannot take ITC. That is this. GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted. As per section 38, in few cases, ITC shall be restricted in GSTR 2B. Then, what is the meaning of input tax? Input tax means tax paid under CGST, SGST, IGST, under FCM or under RCM. So even RCM tax paid also can be availed as ITC. Even on import, whatever IGST paid also can be taken as ITC, but it does not include composition tax. Then what are the contents that should be there in the invoice to be called as an invoice for availment of ITC? Number 1, GSTN of the supplier. Number 2, GSTN of the recipient. Then there should be description, there should be value, there should be tax and place of supply if it is interstate supply. These are the details that should be present. Then only the document will be called as invoice for availment of ITC. Then what is the meaning of inward supplies on which ITC can be availed? It can be inputs, input service, capital goods. Inputs means any goods other than capital goods. Capital goods means those which are capitalized in the books, and input service means capital goods means which is capitalized. So which are charged to P&L will be coming under inputs, which are capitalized will be called as capital goods, and input service means any service which is received will be called as input service, and this should be used in the course or furtherance of business. Then we have a concept of deemed delivery. When the goods are not received by the person, on the instructions of that person, when the goods and service are delivered to a third person, the date on which the third person has received the goods or service on the instructions of the registered person can definitely take ITC. For example, bill to ship to transaction. I am raising invoice to the billing address, but I am delivering the goods to the shipping address. The day on which shipping address has received the goods or services, it is deemed that the billing address has received the goods, and the billing address can take ITC. When goods are delivered to any person or services are provided to any person on the instructions of the recipient, the date on which such person has received the goods or service, it is deemed that the recipient has received the goods or services. That is, in case of bill to ship to transaction, billing address can avail ITC. Then goods received in lots or installments, when the ITC can be availed. On receipt of last lot or installment, ITC can be availed. Then that is wide single invoice. Wide single invoice, this is, remember, it is only with respect to an invoice. With respect to an invoice, with respect to a single invoice, when the goods are received in lots or installment, only on receipt of last lot we can take ITC. Then there is one point, rule 37, which is non-payment of consideration within 180 days from the date of invoice. So the recipient should make payment to supplier within 180 days from the date of invoice. If the recipient has not made a payment within 180 days, the recipient already has availed the ITC, because payment to supplier is not a condition for availment of ITC. So recipient already availed ITC, but he did not make payment to supplier within 180 days. So therefore the recipient should reverse the ITC availed, and he need to also pay interest at the rate of 18% per annum from the date of availment till the date of reversal. But here from the date of utilization, not from the date of availment, from the date of utilization means the balance, the month in which the balance in ITC falls below wrongly availed ITC. If recipient has not made payment to supplier within 180 days from the date of invoice, then so much of the ITC proportionate to the amount not paid to supplier availed by the recipient shall be reversed along with interest at 18% per annum from the date of utilization of ITC till the date of reversal. However, interest is not payable if the availed ITC is not at all utilized. Then this particular 180 days condition is not applicable in 3 cases. Number 1, supplies which are covered under RCM 9 subsection 3 and supply without consideration 71C, and payment to some other person on behalf of the supplier, that is payment to third party on behalf of supplier, section 15(2)(b). So in these 3 cases 180 days condition not applicable, because in third point already we paid to some other person on behalf of the supplier. So due to that reason, it will, that 180 days point will not be applicable, because we are not making payment to the supplier, it's okay. And again, as and when we make payment to the supplier, we can re-avail the ITC without any time limit. And here also interest payment shall not arise if the ITC availed has not been utilized. Also here, whatever proportionate amount is paid, for example 60% is paid within 180 days, we need to reverse only for 40%. Suppose if entire amount not paid, we will reverse, and again thereafter 30% paid, that 30% component can be re-availed. Then ITC not available in case of depreciation computed on GST So that is whenever we are purchasing a capital goods and the GST has been paid on that capital goods, if the depreciation is computed on the tax component, then the tax component cannot be taken as ITC. For example, if the capital goods is 10 lakhs, GST paid on purchase is 1,20,000. Then if the depreciation is computed under section 32 of Income Tax Act block of such method on 11,20,000, then ITC with respect to 1,20,000 is not available. Then section 16(4) time limit for availment of ITC. Usual time limit for availment of ITC is 30th November of the succeeding financial year or date of filing annual return, whichever is earlier will be taken as a time limit for availment of ITC. And the time limit not applicable in case of re-availment of ITC reversed earlier, that is an exception. Then in case of debit note, we need to see the debit note date for the purpose of availment of ITC, not the invoice for which this debit note has been given. So in case of debit note, availment of ITC depends on the debit note date, but not the date on which invoice related to such debit note. Next, second, in case of RCM, this is a latest amendment. In case of RCM, where the registered person issues invoice to the unregistered supplier, usually when the supplier is unregistered and the supply is covered under RCM, the recipient has to give invoice to the supplier under section 31 subsection 3 clause F. So supplier, then the date on which the recipient issues invoice is relevant. The date on which recipient issues invoice is relevant for determining the time limit for availment of ITC, which means now if the recipient is not at all giving invoice to supplier, the recipient cannot avail ITC. That's a very important point. If the recipient has not given invoice to supplier, recipient cannot take ITC. So see the month in which the invoice is given, self invoice given by recipient to supplier, then only it can be availed. But sir, how it will be reflected in 2B? Simple. Whenever the self invoice is given in GSTR1, it has to be reported. Even self invoices needs to be reported in GSTR1. So it will come in 2B and then only it can be availed as ITC. Okay. But still it can be availed as ITC because it comes under the exception because it is RCM. So it will come under 2B, but even if it is not coming under 2B also, still we can take because we have the exception. GST paid under RCM can be availed as ITC. And what is the maximum time limit? Just see the invoice in which date the invoice has been given by recipient to supplier. Based on that date, you determine 30th November of the succeeding financial year or date of filing annual return, whichever is earlier, as a time limit for availment of ITC. Then time limit for availment of ITC for certain financial years. This is a stopgap arrangement which is added in section 16 subsection 5. Again, it is a new amendment, Wide Finance Act 2024, that is for financial year 17-18 to 2021. That is 17-18, 18-19, 19-20, 20-21 for 4 financial years. If ITC is availed beyond the time limit permitted under 16(4), so they missed out the time limit, but they availed at a later point of time, okay, and which has been rejected by the department, on which they went for appeal, etc. and all. Now they are telling it's okay, had you taken, but if we have rejected, still you can avail the ITC. So, but up to the GSTR 3B by November 30, 2021, but this should have been taken by November 30, 2021. So then we will give you, is allowed even though it is in violation of section 16 subsection 4. So all those pending orders which they have rejected, etc. and all, now they are allowing, so you can enjoy the ITC. But only thing is that in 3B you should have taken and it should have been rejected. So now again you will be getting this benefit, you can re-avail, okay, that is this. But sir, how to avail this? For that they have given a procedure. So what is that? Registered person to whom ITC is available under 16(4) or 16(5), they should make an application by 7/4/2025. That is the date by which the application should be made, 7th April 2025. And officer who passed the order of disallowance of ITC at that time, if satisfied, and because of section 16(5), they can re-avail the ITC 16(4) and 16(5). So rectified order in DRC3 or APL4 allowing the ITC. If not satisfied within 3 months, they will reject the order after giving opportunity of being heard. Why they will reject? Because the time limit you have not taken by November 30, 2021, so they will reject it. Then even one more amendment also made in Finance Act, that is time limit for availment of ITC in case of revocation of cancellation of registration. So it so happens that our registration application, like we make an application for cancellation or proper office and initiate cancellation, then we will make a revocation application. Thereafter they pass a revocation order. Now whatever ITCs that we have not taken, can we avail now? Yes, we can avail now, because within 30 days from the revocation order we need to file the returns. In that we can take the ITC, but only one condition is that as on the date of cancellation, the time limit for availment of ITC should not have been expired. So registered person can claim ITC on such invoice or debit notes in any return filed within the regular time limit under section 16(4) or 30 days from the date of revocation order, whichever is later. So as on the date of cancellation, the time limit for availment of ITC is not expired, and now we can take, because that's why where they have given whichever is later. So which means within 30 days from the revocation order, we can definitely take ITC. What if the normal time limit itself is beyond that 30 days from revocation order, then the normal time limit, that's what whichever is later is taken for the purpose of availment of ITC. And what is the important condition? The important condition is that for these invoice or debit notes, the time limit for availment of ITC should not be expired as on the date of cancellation of registration. Okay, for these invoice or debit notes, time limit for availment of ITC not expired. Time limit for availment of ITC not expired as on the date of cancellation of registration. As on the date of cancellation of registration. As on the date of cancellation of registration, the time limit for availment of ITC is not expired. Then we can definitely take this credit. And again the procedure is same. So this is for the purpose of if it is rejected. Suppose in the old claims and all, if they have rejected, then we can make the application for availment of ITC. That is this. Then apportionment of credit, section 17. So here we need to know if we have some inward supplies which is used for taxable outward supplies. Can we enjoy the ITC? Yes. Inward supply is for business purpose also, we can take ITC. If inward supplies are used for exclusively exempted or non-business purpose, ITC not available. If inward supplies are used for both taxable and exempted outward supply, proportionate ITC is available. If inward supplies are used for both business purpose and non-business purpose also, proportionate ITC available. And here zero rated supplies should be brought under taxable supplies for the purpose of availment of ITC. Then what is the meaning of exempted supplies? So total 8 points we have. Number 1, notified as exempted. Some supplies which are notified as exempted, nil rated, non-taxable. These are exempted even for payment of GST, for computation of ITC as well. Then supply covered under RCM. So when my outward supply is covered under RCM, actually it is taxable for payment of GST, my recipient will pay, but for me it is treated as exempted for computation of ITC. Then next 4, sale of land, sale of buildings, sale of securities and supply of warehoused goods under customs. These 4 are actually not a supply but treated as exempted supply for the purpose of availment of ITC. For payment of GST it is not a supply. For the purpose of computation of ITC it is treated as exempted. In case of land we need to take stamp duty value, in case of building also we need to take stamp duty value, but which building is sold? Sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. Then sale of securities, 1% of sale value will be taken, and supply of warehoused goods to any person. So this is also whenever there is a duty free shop and that duty free shop is making sale to incoming passenger, that will be sale of warehoused goods which is excluded. Okay, now see here, there is a duty free shop at international airport, they are making sale to outgoing passengers. So what is it? It's a zero rated supply and normal refund of ITC can be availed. Suppose if the duty free shop is making sale to incoming passengers, then it is treated as exempted for availment of ITC, but supply wise it is not a supply, because it is treated as sale of warehoused goods under customs, and it would be treated as exempted supply for reversal of ITC, and whatever purchases by them within India are chargeable to GST and they can avail ITC. Okay, so remember, whenever there is a duty free shop making sale to incoming passengers, that is excluded from supply, but for ITC purpose it is treated as exempted supply. Then next, one more point, even though 2 transactions are exempted, but it will be treated as taxable for availment of ITC, that is interest on loans, advances, deposits or sale of duty credit scrips. So that is discussed below. You can see service by way of accepting deposits, extending loans or advances in so far as the consideration is represented by way of interest or discount, except in case of banking company or financial institution or NBFC. That is one. Another area, generally sale of duty credit scrips is exempted, but for availment of ITC it is treated as taxable supply. These 2, even though exempted, these 2 are connected to this, even though it is exempted, but it will be treated as taxable for availment of ITC, means it will not come under exempted. So meaning of exempted supplies excludes that. Then what is the manner of availment and reversal of ITC? So we have rule 42 and rule 43. Rule 42 is for inputs and input services, rule 43 is for capital goods. Rule 42 says, first we need to see the total GST paid on inward supplies, that is T, and now we need to segregate into 4, that is inward supplies for non-business purpose T1, inward supplies for exempted supplies T2, inward supplies which are blocked credits T3, and inward supplies which are used for taxable and business purpose T4. So we need to segregate that inward supplies into 4, and thereafter So how much is the ITC availed in GSTR 3B? ITC availed in GSTR 3B is T minus T1, T2, T3. So T minus T1, T2, T3, C1, that is the ITC availed in GSTR 3B. Now what is the common credit? So common credit is everything, that is this C1 minus C2. First we need to take T. T refers to total GST paid on inward supplies minus T1, T2, T3. T1 blocked credit, in on business purpose. T2 exempted, T3 block credit. Now the balance, we will avail the ITC in 3B. Thereafter you take out T4, which is exclusive for business and taxable. Full credit we can take, and the remaining leftover is known as common credit. This common credit, we need to again reverse D1 and D2. D1 attributable to common credit attributable to exempted supplies, that is C2 common credit into E by F, exempted supplies divided by total supplies. Then common credit attributable to non-business, means out of this common credit, even if one inward supply is used partly for business, partly for non-business, the entire common credit into 5%, we need to do the reversal. So entire common credit into 5%, we need to do the reversal on ad hoc basis. Suppose you know exactly how much is business, how much is non-business, that we can divide in this stage itself. Now what is the ITC availed? ITC availed is C1, and what is the ITC reverse? This D1 and D2. Now the remaining is called as net eligible ITC for set off, and this should be computed separately for CGST, SGST, IGST, and again this computation needs to be done at the end of the financial year, and whatever we need to reverse at the end of the financial year is more than what we have already reversed. So then the differential amount we need to pay along with interest at the rate of 18% from 1st April of the succeeding financial year, means it will be done at the end of the financial year. So 1st April of the succeeding financial year till the date of reversal, actual reversal of the difference, we need to compute interest at the rate of 18% per annum, and D1, D2 will be computed for the whole financial year by taking exempted turnover and aggregate turnover for the whole financial year. If this amount is more than the amount already reversed to the liability, then the differential amount will be added to the output tax liability in the month till September. So maximum time limit, by September we need to pay off the difference along with interest at the rate of 18% from 1st April of the succeeding financial year till the date of reversal. And suppose if the amount is less, which means that what we have reversed is excess than what we were supposed to reverse, so then the difference can be availed as ITC. If this amount is less than the amount added to output tax liability every month, the additional amount paid has to be claimed back as credit in the return on any month till September of the succeeding financial year. Then we have rule 43, which talks about availment of ITC in case of capital goods. Simple, if we have capital goods 1, so capital goods 1 which is used fully for taxable and business purpose, can we take ITC on this? Yes, we don't have any restriction, we can take ITC. We have capital goods 3 which is used fully for exempt or non-business purpose, can we take ITC? No, we cannot take ITC. But we have some common capital goods which is partly used for taxable or business, partly used for exempted or non-business, partly for taxable, partly for exempted, partly for business, partly for non-business, still we can take the ITC, but proportionately we need to do the reversal. What is the treatment in case of capital goods 2? First, you avail the entire ITC and it will be posted to electronic credit ledger. Thereafter, every month, over 60 months, we need to see what is the monthly ITC, that is total ITC with respect to common capital goods divided by 60 months into E by F, that is exempted turnover of that month divided by total turnover of that month, we need to reverse. So compute monthly credit. What is the monthly credit? ITC availed divided by 60 months. Here life of the capital goods will be taken as 60 months, 5 years or 60 months. Can we take a period less than 60 months? Yes, but that should be given in the question. Okay, so otherwise we will take 60 months. For the next 60 months from the date of purchase, compute the monthly ITC attributable to exempted supply. How to compute? Monthly ITC into exempted turnover of that month divided by total turnover of that month. Plus we need to pay interest at the rate of 18%, but here it is from the availment. Here it is from the availment of ITC 18% per annum till the month of reversal. For example, for 60th month if we are doing reversal, for 59 months from month 1 to month 60, we need to do the interest computation. The above procedure not required from the month in which capital goods are sold, as GST is payable in such case under section 18(6). Then next one, suppose initially you purchase the capital goods and CG1, initially you purchase the capital goods and at a later point of time it became CG2. That is common capital goods. What is the treatment? At the time of purchase itself, we know that we are using it for taxable, so we would have taken ITC. In the month of conversion onwards, so we need to reverse because it became common. So from the month of conversion for the balance life, the overall life is 60 months. Say after 2 years, we converted for remaining 3 years, that is 36 months, we need to reverse ITC. ITC already availed at the time of purchase, so no need to avail common credit. But monthly ITC will be original ITC divided by 60. proportionate reversal from the date of conversion for balance useful life, and for computation of interest, we need to take ITC availment as the date of conversion. Date of conversion you take for the purpose of computation of interest, because interest at the rate of 18% from the date of availment till the date of reversal. Now here date of conversion will be taken as the date of availment. Then initial purchase capital goods 3, and at a later point of time capital goods 2. Then what is the treatment with respect to this? Initially you purchased and used for CG3. So then in that case, can we avail the ITC? So yes, we cannot avail ITC. Why? Why we cannot avail ITC? Because initially we purchased and used for exempted, so we would not have taken ITC. But now you are using it for common, so we can take the credit now. Now we can take the credit. So ITC not availed at the time of purchase, so it should be availed now. That is whatever is the original GST paid, that can be availed. And ineligible ITC to be reversed for the period it is used for exempted. Say for example last 2 years it is used for exempted, so that is bulk reversal for the past period. So how we need to do that? So ITC availed into, that is GST paid into 5% for every quarter or part thereof from the date of purchase till the date of conversion. So we need to compute and we need to reverse that. GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. So month-wise quarter should be taken. Okay. So what is month-wise quarter? I mean month-wise quarter here refers to like 3 months will be taken as one quarter. Okay. 3 months will be taken as one quarter, quarter or part thereof. So we need to do that. And monthly ITC is original ITC divided by 60 months and proportionate reversal from the date of conversion for the balance useful life. Interest computed from the date of conversion. Here remember calendar quarter, month-wise quarter means don't get confused. It is like, say till the month of conversion, you need to count the quarters, and here you need to see how many months you have used based on that. Calendar quarter only, everywhere in GST calendar quarter only. So proportionate reversal from the date of conversion for the balance useful life. Interest computed from the date of conversion, same. And whether ITC to be reversed by life insurance company on the portion of premium not included in the value as per Rule 32 sub Rule 4. In valuation, Rule 32 sub Rule 4 says that in case of life insurance business, single premium annuity 10%, and suppose if it is reinvestment policy, premium collected minus amount allocated for investment, and even in case of other policies 25% of first year premium, 12.5% of subsequent premium. Now that much is only taxed, remaining is not taxed, remaining premium is not taxed. So that remaining premium which is not taxed, should it be treated as exempted for the purpose of reversal of ITC by insurance company? No, it is not like that. The value itself is the 25% or 12.5% component, so remaining should not be considered as exempted. Premium value not included in the taxable value is not considered as exempted or non-taxable supply. Therefore, ITC reversal shall not arise in terms of Rule 42 or 43. Then next we have 17 subsection 4, that is special provision for availment of ITC by a banking company, financial institution or NBFC. So they have two options. Option 1, they need to do the proportionate ITC method as per Rule 42, Rule 43. Whereas option 2, ad hoc ITC method, that is 50% of the ITC they can take, that is ad hoc ITC method. Now in case of option 2, inward supply is exclusively used for exempted, inward supply is exclusive for taxable is also treated as common, means 50% only we will take. In case of option 2, inward supply exclusive is for non-business and blocked credits under 17.5. Non-business we will not take, blocked credit we will not take, but exclusively used for exempted and exclusive is for taxable also will take 50% on remaining ITC. 50% compute on remaining ITC including used exclusively for exempted and exclusively for taxable. In case of option 2, restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity. That is inward supply from distinct person we can take full ITC 100%. No need to reverse 50% with respect to inward supply from a distinct person. Option once exercised cannot be withdrawn during remaining part of the financial year. So we need to decide any one option that will be applicable throughout the financial year, and we cannot do any reversal etc. with respect to this. Okay, that is with respect to 17 subsection 4. Then we have blocked credits, 17 subsection 5, motor vehicle related block credit. So motor vehicles are divided into 3 total, that is for transporting persons, vessels and aircrafts, and other motor vehicles. Other motor vehicles not at all restricted, so we can happily take ITC like lorries, trucks etc. Then motor vehicle for transporting persons, capacity does not exceed 13, capacity exceed 13 including driver. Capacity exceed 13, ITC available, example buses, stage carriages, contract carriages. capacity does not exceed 13, like 2-wheelers, 4-wheelers, etc. So here it is block credit. However, we have 3 exceptions. If it is used for further supply, purchase and sale, or if it is used in the business of transportation of passengers, or if it is used for imparting driving skills, we can definitely take ITC. For vessels and aircrafts, generally block credit, but 4 exceptions we have. Number 1, used for further supply. Number 2, used in the business of transportation of passengers. Number 3, for imparting driving skills. Number 4, for transportation of goods. They need not be in the business of transportation of goods. If they are using it for transportation of goods, they can take ITC. ITC available. Then 4 services in relation to motor vehicles. Repair and maintenance services, then insurance service. Servicing means authorized service station, and then hiring, renting and leasing of motor vehicles. These 4 services in relation to motor vehicles, vessels and aircrafts. If the motor vehicle, vessel and aircraft is eligible for ITC, then on these service also ITC can be availed. If the motor vehicle, vessel and aircraft not eligible for ITC, on these 4 service also ITC not available. Then there are some special points. While determining the capacity, driver seat should be included. Further supply includes purchase and sale of motor vehicles or renting of motor vehicles. For example, I am into the business of renting of motor vehicles. If I buy a motor vehicle, can I take ITC? Yes, I can take ITC. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. For example, there is an insurance company which has paid the bill for the accident that happens to the motor vehicle. Now, the repair bill will be in the name of the insurance company. They can definitely take ITC. There is no restriction with respect to that. Then hiring or renting of leasing of motor vehicles as statutory obligation. Generally, if the motor vehicle purchased is not eligible for ITC, renting of motor vehicle also not eligible for ITC. But if that renting of motor vehicle is under a statutory obligation, which is mandated under any law for the time being in force, ITC is available. Statutory obligation can be under any law. Then ambulance and caravan. Ambulance purpose is not for transportation of persons, caravan also not for transportation of persons, or not motor vehicles for transportation of persons, and they can take ITC because it will come under other motor vehicles. Even this restaurants which is using the 2-wheelers for food delivery also will come under other motor vehicles because there will be one box that is fitted on the back, so it will come under other motor vehicles and they can take ITC. Next, there is one latest amendment related to demo vehicles. On demo vehicles can we take ITC? Usually automobile dealers will be getting a demo vehicle. Usually that is not their inventory, that will be capitalized because it is their asset. They will keep the demo vehicle and for using it in trials by the buyers, prospective buyers. And logically speaking, they should not take ITC because they are not selling the demo vehicle now. Whenever they sell the demo vehicle, they can take ITC. But CBSE clarification given that automobile dealers usually buy this and that will be supporting them in making further supply. That is, even though this they are not selling now, but because of this they will be able to make sales. Due to that reason, this also will be sold in future, but not now. So definitely ITC can be availed. ITC is available on demo vehicles if they are used for promoting further supply of motor vehicles. If the demo vehicles are capitalized, one condition, so we should not compute the depreciation on the tax component. ITC is available unless depreciation under section 32 is claimed on the tax component. Also, sale of such capitalized demo vehicles, GST will be payable under 18(6). That is, already we took the ITC on this capitalized demo vehicle. So when we are selling sale of capital goods on which ITC availed, 18(6) will come. That is ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of conversion, or GST payable on sale value of the capital goods, whichever is higher. So if the demo vehicles are used for non-business purpose or as a part of marketing services for the manufacturer, ITC is blocked. They cannot take ITC. It should be really given for the trial. It should not be used for marketing purposes or by the owner, that is automobile dealer. It should be used for the customers to trial. So then only ITC is available. Then next, whether ITC is available to insurance companies on the expenses incurred for repair of motor vehicles. So generally, whenever insurance company gives the insurance, the repair bill will be in the name of the insurance company. Can the insurance company take ITC? Yes, they can take ITC. But it so happens that it is like a reimbursement mode of settlement claim, wherein first this person will pay and then the insurance company will reimburse the person. For example, I am the owner of the car. Now I will pay first. It's not cashless. I will pay first and then insurance company will reimburse me. So insurance company can avail ITC even though expenses initially incurred by the insured, even though initially I pay. However, invoice should not be in my name. Invoice should be in the name of the insurance company. Then insurance company can take ITC. What if invoice is in my name? It depends on me. Like suppose if the car is eligible for ITC for me, I can take ITC on repair services. If the car is not eligible for ITC on repair service, I cannot take ITC. That point will be applicable. But insurance company always ITC is available. Suppose if the repair cost is beyond the approved claim, for example, repair is somewhere like 40,000. In that 40,000, 30,000 insurance company borne and 10,000 rupees I am bearing. But the bill is in the name of insurance company. How much insurance company paid? Only 30,000. So proportionate to the 30,000 only they can take ITC. ITC to the extent of amount reimbursed by the insurance company, but not on the entire repair cost. Then invoice in the name of the insured. Invoice is in the name of the insured. Definitely ITC cannot be availed. So to insurance company as conditions not satisfied. But about insured? Depends. That is, insurance is one of the inward supply. If the motor vehicle eligible for ITC, ITC available on insurance. If the motor vehicle purchase not eligible for ITC, then ITC not available on insurance services. Then we have construction related block credit. That is, three inward supplies. Any service, works contract service or goods. These three are purchased or received in relation to construction of an immobile property, then it is blocked credit. ITC not available on those inward supply. Any service for construction, interior decoration, architect or construction, anything, then works contract. Any goods purchased. Works contract means what? That involve transfer of property in goods as well as provision of service for a single consideration. Now, for this we have three exceptions. Number one, this restriction is not applicable to the supplier, only to the owner of the property. If the supplier is receiving services or purchasing goods for construction, he can take ITC. Number two, second exception is that this is not applicable for plant and machinery. So if there is a expenditure incurred for construction of plant and machinery, we can take ITC, but plant and machinery excludes telecommunication towers and pipelines laid outside factory gate. Then number three, suppose if the construction expenditure is charged to P&L, then also we can take ITC. If it is capitalized, we cannot take ITC, but if it is charged to P&L, then ITC can be availed. Even though in these exceptional cases ITC available, first point, supplier can take ITC, but depends upon the supplier's outward supply. For example, there is a builder. So as per law, builder can take ITC, under 17.5 he can take ITC. But the problem is, what is the GST rate applicable to the builder? If the GST rate applicable to the builder is 7.5% or 1.5%, that is without ITC, they cannot take. Even though exception 1 says they can take, but depends upon their rate of GST. Suppose if the applicable rate of GST to builder is 12% or 18% with ITC, definitely ITC available on the inward supplies. Then whether ITC available on the ducts and manholes used in network of optical fiber cables. Yes, ducts and manholes, definitely they can take ITC. Okay, so basically these ducts and manholes are integral part of optical fibers. Usually what will happen, so they will lay down the optical fibers. So for that they create the duct pipes and the manholes. So whether it will come under telecommunication towers, because of which ITC not available? No, this is not telecommunication towers. Then will it come under pipelines laid outside the factory gate? That is only for the factory, not for a normal telecom company. So ducts and manholes which are integral part of optical fiber cables qualify as plant and machinery and can avail ITC on the same, even though used by the telecom companies, as only telecommunication towers are excluded from the meaning of plant and machinery, even they do not fall under the pipelines laid outside the factory gate. Then point number one, only hiring, renting and leasing a motor vehicle is blocked ITC. However, leasing of other items is not blocked ITC. For example, leasing of furniture, leasing of any infrastructure, building, that can be taken as ITC. Works contract service confined only to immobile property. ITC available on construction of pipelines inside the factory. ITC available on rails, train purchase or 2 or 3 wheelers with a capacity up to 25 cc. So because beyond 25 cc is only motor vehicle, up to 25 cc is not motor vehicle, definitely they can take ITC with respect to that. These are some special points. Next, we have other blocked credits. In other block credits, we have some inward supply, that is membership of a club, health and fitness center. So we cannot take ITC, membership of a club, health and fitness center, but we have one exception. Suppose if it is incurred by employer to employee under a statutory obligation, then ITC is available. Then travel benefits extended to employees on vacation. Again, what is the exception? Suppose if it is provided by employer to employer under statutory obligation, they can take ITC. Then inward supply of non-resident taxable person, a person who is coming from outside India to India and is not having any physical place of business in India, will be non-resident taxable person. They need to register, but they cannot take ITC except on import of goods. If they import any goods, IGST paid on import alone can be taken as ITC. Then we have food and beverages. Then food and beverages includes outdoor catering related to food, then related to beauty treatment, grooming, and then cosmetic surgery, plastic surgery, hair transplantation. Then we have hiring, renting and leasing of motor vehicles. Then number 4, insurance, that is health insurance and life insurance. These four in relation to motor vehicles. What are the exception? These four invert supplies. So food and beverages, beauty treatment, then life insurance, health insurance services. What are the exceptions? If invert supply, outward supply in the same category, we can take ITC. Invert supply part of outward supply, so then also we can take ITC. If it is under a statutory obligation, we can take ITC. Under Factories Act, as a mandatory obligation, if they have received outdoor catering to provide food to their workers, they can take ITC. If there is a person who is in the business of transportation of passengers, if they receive the food and beverages, they can take ITC. So that is this. Invert supply, outward supply, same category means I am into the business of sale of food and beverages. Food and beverages, I can take ITC. And invert supply part of outward supply, either composite or mixed outward supply, and if it is under a statutory obligation. Then balance. Suppose if I am having invert supplies from a person opting for composition scheme, I cannot take ITC for personal consumption. So then next, for use in relation to obligations under CSR, for CSR obligations also I cannot take ITC. Suppose if the goods are lost, stolen, destroyed or written off or disposed of as goods or free samples, then also I cannot take ITC. Then however, if the gifts or free samples become supply, then ITC is available. ITC not required to be reversed. Also GST paid under section 74, that is not voluntarily paid, it is recovered from the person by way of fraud, collusion, willful misstatement, suppression of facts. A demand order will be passed under 74 and it will be recovered. 129. So 129 is when he is transporting the goods in transit without documents, that is intercepted by the proper officer, and they will recover, they will levy penalty and recover the tax under 129. Then 130. Basically 129 is only for payment of penalty, not tax. Then 130 confiscation. So that stage also we may pay some tax, but all these not voluntarily paid. It is recovered by way of compulsion from the supplier. Moreover, he will not report it in GSTR1. Consequently, it will not come in 2B. So we cannot take ITC with respect to that or any other recovery proceedings. Such GST paid cannot be availed as ITC. Then, so many students ask me whether November 25 amendments we should read. No, not required, just November 25 only. So you need to focus only on May 25 amendments right now. Then, whether ITC available on the goods purchased for free replacement during warranty period. So these are some important points. Generally, whenever we purchase any goods for free replacement during warranty period, definitely we can take ITC. Simple point. So that can be entire product may be replaced or maybe part can be replaced. Just remember two examples. Example number one. So you purchased a car, you are my customer, you purchased a car, I am the dealer, and there is an issue. So say sensor is not working in that car, you are bringing me the car and that sensor is a defect. So I have a part, sensor, and I replace the part. Okay, free replacement of a part. So can I take ITC on the sensor purchased? Yes. Number two, suppose you purchased a torch, battery operated torch. It is not working. The entire torch I will replace. Now I need to buy the new torch and replace it. Can I take ITC on the new torch purchased? Yes. So whether a part or entire product is replaced during the warranty, ITC can be availed on the goods purchased for warranty, irrespective of whether I am going to charge any consideration or not with respect to such warranty repairs. Okay. Now here, won't it come under disposal of business asset on which ITC availed? Yes. It may be supply, and because of which we need to pay, but that is not applicable. It is not a supply. That's what circular says. It is not a supply. 71C will not get attracted. You enjoy the ITC. Then whether distributor uses his stock for replacement. So he may be using his stock for replacement. Okay. Or the manufacturer may replenish the stock on which manufacturer can take ITC. So if the distributor uses his stock, he can take ITC on the stock purchase, and that stock will be replaced by the manufacturer. Now manufacturer will buy, manufacturer also can take ITC. Now when the manufacturer is sending the stock to the distributor as a replenishment means refilling, so that will not be supply, it will be under the cover of a delivery challan. Then next, amount paid for extended warranty. This is another part. The first part is related to warranty, that is replacement of parts during warranty. Next one is amount collected for warranty, additional warranty. What is the treatment of amount collected for additional warranty? So if amount paid for extended warranty taxable at the same rate applicable to goods, when suppose if it is collected at the same time at which the goods are sold. For example, I am selling a TV. TV is 28% and you are purchasing extra warranty for 3 years. So now at the time of sale of TV, from the same dealer, if you pay extra money for warranty, the rate applicable to TV will be taken for warranty. Rate of TV 28% means warranty also will be 28%. Amount paid for extended warranty taxable at the same rate applicable to goods if the warranty is taken from the same supplier at the time of purchase of goods. If the amount for extended warranty is paid to another supplier, so same supplier, same time, rate applicable, like a composite supply, principal supply will be applicable. any other case. Suppose if it is from a different supplier, it's a separate supply, treated as separate supply. So for warranty, whatever is rate, that should be taken. If the amount paid for extended warranty after purchase, whether it is from the same supplier or different supplier, then also it's a separate supply. See, when it is composite supply, same time, same supplier, composite supply, take the rate of main product and apply it on the warranty. In all other cases, it is separate supply. If the amount paid for extended warranty after purchase of goods, then it is treated as a different supply, whether purchased from the same supplier or different supplier. Then ITC in special circumstances, section 18 of CGST Act. Section 18 subsection 1 talks about availment of ITC on closing stock. So 18.1 talks about availment of ITC on closing stock. In 4 situations, we can avail the ITC on closing stock. 18.1a, I am liable to get registered. I make application for registration within 30 days. 18.1b, voluntary registration. 18.1c, I am under composition scheme and I am going into normal scheme. 18.1d, so far my outward supplies was exempted, now it became taxable. 18.1c and 1d, that person should be a registered person. Registered person migrated from composition scheme to normal scheme. Registered persons, exempted supply became taxable. When he is making exempted, why is he registered? Means he is also making taxable as well as exempted, because of which he is registered, and some of the exempted supplies now became taxable. That is the meaning of that. In case of 18.1a and 1b, situation is only different, but the ITC availment will be same. They can take ITC on closing stock, that is inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Which date? So which date? In case of 18.1a, before the date they are liable to get registered. 18.1b, before the date they got the registration certificate, and matching is not required in this case. Whereas 18.1c, 1d, they can avail the ITC on closing stock, that is inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock, even on capital goods. But capital goods, how much they can take? That is GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion they can take. And very important point, matching is required in this case. Which date closing stock should be taken? Before the date of conversion, from composition scheme to normal scheme, from exempted supplies to taxable supplies. And the above closing stock, including capital goods, should have been purchased within 1 year prior. ITC with respect to GST paid on inputs fully can be taken as ITC, but capital goods we need to reduce 5% for a number of quarters from the date of purchase till the date of migration or conversion. Then we need to avail this ITC by filing one declaration in ITC 1, an electronic declaration in ITC 1 that should be filed within 30 days from the date we get the registration certificate, or within 30 days from the date of conversion, and it can be extended for a further period. And this declaration should be certified by a CACMA if the claim of ITC exceed 2 lakhs. If the claim of ITC does not exceed 2 lakhs, self declaration or self certification. Then 18 subsection 3 talks about transfer of ITC. So when there is a transfer of business, I have some business, I am transferring that business to you with the specific provision for transfer of liabilities, means all the assets and liabilities I am transferring. Then the unutilized ITC from my business, it will be transferred to your business. Where there is a change in constitution of registered person on account of sale, merger, demerger, amalgamation, lease or transfer of business with specific provision for transfer of liabilities, the said registered person shall be allowed to transfer the ITC which remains unutilized in his electronic rate ledger to such sold, merged, demerged, amalgamated, leased or transferred business. Okay. And the transferor should be furnishing a form in ITC 2, and the transferee will accept that, and therefore ITC will be transferred. And here remember, we need to get a CACMA certification so that the transfer of business is with specific provision for transfer of liabilities. What will happen in case of demerger? From single unit it is going into 2 units, so we need to take the ratio. What ratio? Assets ratio. Assets, assets, what assets? Total assets. Total assets we need to take whether ITC availed or not on that asset should be taken. In case of demerger, credit shall be transferred to the new entities in the ratio of net assets whether ITC availed or not on such assets post demerger. Then transfer or change in ownership of business will include transfer or change in on account of death of sole proprietor. So when the sole proprietor dies, the successor should get a new registration and the ITC can be transferred. And one important point is that transferor and transferee should be in the same state. If the transferor in Karnataka, transferee in Tamil Nadu, it is not possible. And also when there is a single registration which is getting separated into multiple registration, so far the ITC which was in single registration can be separated to multiple registrations by filing a form, that is ITC 2A. So that ITC 2A, again here also we will take the assets ratio as on the date of new registration. and this ITC2 to be certified by CACMA irrespective of the amount of ITC. However, ITC2A is not required to be certified by anyone. In case of demerger, balance in ITC, which date balance in ITC should be taken? As on the date of transfer, not as on the date of demerger. As on the date of transfer, and ratio of assets on the date of demerger should be considered. Then next we have 18.4 and 29.5. So 18 subsection 4 is opposite of 18.1C1D, and 29 subsection 5 which talks about reversal of ITC because of cancellation of registration. So total 3 situations. You are under normal scheme, you are going into composition scheme. Opposite of 18.1C, you are having taxable supplies. Now you have started making exempted supplies. 18.1D opposite. Then cancellation of registration. In these 3 cases, we need to see the closing stock, and we need to reverse there we avail the ITC on closing stock, here we need to reverse the ITC on closing stock. What is that? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Whatever ITC availed, that we need to reverse. And capital goods also we need to reverse. How much? ITC availed divided by 60 months into balance life, we need to reverse. And inputs and capital goods can be purchased any time on which ITC availed. There is no time limit restriction. There for availment of ITC 1 year restriction. But here there is no such restriction. If ITC not availed on such inputs and capital goods, then the reversal shall not arise. Also, if the capital goods are purchased before 5 years, life is over, there is no balance life. So the reversal shall not arise. Suppose if the invoice pertaining to this closing stock date is not available on these inputs, etc., then we need to take the market value. If invoice pertaining to such inputs not available, then the market value will be considered, and we need to get a certificate from a practicing CACMA certifying this is the correct market value. And all these details of ITC reverse needs to be reported in GSTR, that is ITC 3, GST ITC 3, and if there is any balance in ITC, even after reversal, the balance will be lapsed. If there is any shortfall, we need to pay. If there is any shortfall, then the shortfall payable through cash ledger, and we need to do this computation separately for CGST, SGST and IGST. Then we have section 18 subsection 6 which talks about capital goods are purchased on which ITC availed. Now the capital goods are sold. Then we need to compute the GST payable, which is ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST payable on the sale value or the value of the capital goods. That value will be either transaction value if it is without consideration, value under rule 30 or rule 31. And in case of refractory bricks, molds and dies, jigs and fixtures, these 3 cases, if it is sold as scrap, don't see this point ARB whichever is higher. These 3 are capital goods. Don't see this point ARB whichever is higher, just take the B part, that is sale value, whatever is the sale value of that scrap on the GST rate. This section not applicable in case of refractory bricks, molds and dies, jigs and fixtures supplied as scrap. In such case, GST payable on the normal sale value. Then we have job work provision section 19 read with section 143 of CGST Act. So we need to first try to understand the procedure. The procedure here is that there is a principal who is a registered person. So he purchases inputs and capital goods, and these inputs and capital goods at the time of purchase GST paid is availed as ITC. Now these are sent to the job worker, and when this is sent to job worker, it is not a supply. So therefore the principal is not required to reverse any ITC, but there is a condition that the job worker should return the goods. This time limit is given in section 143. Section 143 they gave the time limit that the job worker should return the processed goods within 1 year plus 1 year, and capital goods within 3 years plus 2 years. They need to return it to the principal within 1 year. So processed goods 1 year plus 1 year, and capital goods 3 years plus 2 years. But time limit is not applicable for molds and dies, jigs and fixtures and tools. Here we have 3, that is refractory bricks, molds and dies, jigs and fixtures. So these 2 are common, molds and dies, jigs and fixtures. Extra what we have is tools sent on job work, tools sent on job work. Then what will happen? Point number 5, suppose if the goods are not returned to the principal within the time limit, then it will be deemed as supply to the principal. Which date? On the date it is dispatched to the job worker. On the date of dispatch to job worker, it is deemed as supply. If the goods are directly received by the job worker from the supplier of that principal, then the date of receipt by the job worker, it is deemed as supply. So then supplier of principal, then the date of receipt by job worker, it is deemed date of supply. And this principal has to report all these details in one form, that is ITC 4, and if it does not exceed 5 crores, if the turnover during previous year does not exceed 5 crores, then it should be filed only once in a year by April 25th of the succeeding financial year. If it is aggregate turnover exceeds 5 crores, half yearly we need to file. First half year by 25th October of the next financial year, and next half year by 25th April of the remaining half year. So half yearly we need to file. And this is about the procedure for job work, and such goods should be sent on job work under the cover of a delivery challan and e-way bill. Even if the goods are directly received by job worker, ITC can be availed by principal because bill to ship to transaction. Job worker, if registered, they will buy some inputs and input services on which they can take ITC. If the processed goods or capital goods are returned by job worker after 1 year, as they are not returning within 1 year or 3 years, it is deemed as supply for the principal and they pay GST. Now again, job worker is sending it back after 1 year, it is treated as a new supply made by the job worker. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years, it is treated as a new supply by job worker and chargeable to GST, which can be availed as ITC by the principal. What if job worker is not registered? The principal should declare the job worker's place as additional place of business of the principal, and jurisdictional officer must be intimated about the job work contract, and any processed goods may be brought back to principal's place, or it can be directly sold from job worker's place or exported from job worker's place. Okay, these are the points related to section 19, which is important. 19 read with 143. 143 contains a time limit. 19 contains the deeming fiction of supply. Then we have section 20 and 21, which talks about input service distributor. So who is an input service distributor? A head office or a corporate office which receives the inward supplies of services and avail the credit and distribute the credit to the divisions under the same permanent account number. So receive tax invoices for input services and distribute the ITC by issuing ISD invoice, and they need to get a separate registration as an input service distributor. All these divisions should be under the same permanent account number. Here CGST and SGST distribute as CGST, SGST for the unit in the same state, whereas for unit in a different state it will be distributed as IGST. Suppose if the input service is attributable to one unit, entire credit will be distributed to that unit. If the service is attributable to 2 units, then we need to apportion between these 2 units and distribute it in the turnover ratio. So 2 or more units, such 2 or more units in turnover ratio. Suppose if it is common for all units, then all units which are operational based on the turnover ratio. And which turnover should be taken? Either take the turnover of the previous year or the last quarter, depending upon the availability we can take. ITC to be distributed on a monthly basis. Monthly we will take and distribute, and whatever ITC distributed should be reported by the ISD in GSTR 6 by 13th of the month following every month, and the excess distributed ITC can be recovered by giving a ISD credit note. Suppose by mistake excess credit distributed without following the turnover ratio, that can be recovered by the ISD from the division using ISD credit note. Shortfall in distribution can be distributed using ISD invoice. Distributed credit should not exceed the credit available for distribution. Suppose if the ISD has distributed excess credit to the recipient, such excess department can recover by initiating recovery procedures as per section 21 along with interest. ISD should obtain a compulsory registration irrespective of their aggregate turnover. Then while computing the turnover in 3 places, that is rule 42, rule 43 and section 20, these 3 places when we do the turnover computation, the old indirect taxes should not be taken, like excise duty, central sales tax and value added tax should not be taken. Also value of supply of duty credit scrips should not be considered as taxable turnover. This is an important point in everywhere. Then so whether we need to follow ISD or cross charge. For ISD there is an alternative, that is cross charge. Either ISD or cross charge can be followed by head office for distribution of credit to branch office. Which credit? So that is whatever credit that they have procured from a third person, that either they can follow ISD model or cross charge. Cross charge means they themselves will raise invoice. In case of cross charge, normal invoice raised by head office to branch office, turnover ratio need not be followed, but these service should be attributable to the branch office. So these are the key points related to input tax credit. So with this we completed the revision of ITC.